All right, we've gotten to the point of discussing special journals. We're at that point. We made it. We've made it. What we're talking about with the special journals and what we're going to introduce in this special journals discussion is 4 additional journals to that general journal that we've become familiar with already. In the accounting cycle, that first step says analyze and journalize. So we're focusing on that step 1 of the accounting cycle when we talk about special journals by introducing 4 additional journals to that general journal, and therefore having 5 different journals to record our transactions in. And each of these journals will record a certain type of entry. All right, so let's list them first. General journal, we know this one. Now we will introduce sales journals, cash receipts journal, okay, and then these two go together. Then purchases journal, and cash payments journal. Okay, payments, you might also see sometimes, is called the cash disbursements journal. And purchases and cash payments or cash disbursements journal also go together. So accounting for the office assistant, chapter 6 deals with sales journals and cash receipts journals, just those two. And then chapter 7 talks about the purchases and cash payments journal. Human Resource Management Certificate students, all 4 of these are in Appendix 2. Okay? But overall, this is a special journals discussion. At the point of concluding our discussion on sales and cash receipts, I'll make sure to record that time so I can put it in the note on the video to specify when chapter 6 ends and when the sales and cash receipts journal ends, and then when the purchases and cash payments journal discussion begins. All right, so remind me if I forget. I'll be on alert. Each of these 5 now, including this general journal, will record a certain type of transaction. The general journal will record, and if it helps, take this down because, of course, I'm going to be erasing as we go through the discussion. The general journal will record all of our adjustments. So adjustments are step 4 in the accounting cycle. Any adjustments, all the depreciation, the accrued expenses, accrued revenues, unearned revenues, prepaid assets, used supplies, all of those adjustments get recorded in the general journal, not in any of these special journals. Okay, and we're talking about the types of entries generally in accounting that go into all these journals. General journal only used for adjustments, and what we're going to talk about in relation to these special journals will be the returns and allowances. And this could be sales returns and allowances or purchase returns and allowances. So we'll show how to record them, We did already bring up those two in the perpetual and periodic video. But anytime a sales return and allowance happens or a purchase return and allowance happens, it gets recorded in the general journal. And then that is all that gets recorded in the general journal. Anything else will be now specified in these other ones. Sales journal will record only one type of entry, or excuse me, one type of transaction, and that is a credit sale. Anytime we make a sale on credit or on account, it gets recorded in the general journal. Credit sales. So are we recording any cash sales in the sales journal? No. Why would we? We're only recording credit sales in the sales journal. In the cash receipts journal, though, we are recording any inflow of cash into the business. Remember, all recording and all accounting is done through the eyes of the business. What's good for the business, what's coming into the business, what's leaving the business. And the cash receipts journal will record all and any inflows of cash into the business. And there's 3 ways that cash will flow into the business. 3 ways. But for now, we will put for the cash receipts journal, all cash inflows. Yeah, you can see that. All cash inflows, for now, I'll just mention the 3 ways. How can cash come into the business? Number 1, an investment into the business. Remember back in the beginning of the course where we talk about when you first open the business and you invest into it with cash, that will increase your cash and your capital. So into the business, cash is coming by means of this investment. So that's the first way that cash will come into the business. A second way is to collect some of these credit sales from the sales journal. Right? Credit sales means that an accounts receivable was created, and now that customer is paying us off, which means the accounts receivable is converting into cash. That's the second way that cash can flow into the business. And third way is by making a cash sale. So the opposite of making the credit sale. Instead of making the credit sale, we're directly receiving cash at the point of sale. Those 3 inflows of cash get recorded in the cash receipts journal. Okay? And those are the only things that get recorded in the cash receipts journal. So you're already starting to see how organized we can be by using all 5 of these. In the purchases journal, similar to the sales journal, we are only recording credit purchases. I heard somebody say it. Credit purchases will be the only type of account transaction that gets recorded in the purchases journal. Only credit purchases. The cash purchases, as well as any cash outflows, will be recorded in the cash payments or cash disbursements journal. And there are 3 ways that cash can leave the business. 3 ways that cash will leave the business that get recorded in the cash disbursements or cash payments journal. So for now, we're just going to put all cash outflows. And what are those 3 outflows? They will be related to these inflows. One of the inflows in the cash receipts journal is by making a sale with cash. So you're receiving cash right away. One of the ways that cash can leave the business is by us paying cash at the point of sale for something. Either we're buying inventory or another asset. We're paying for something using cash, That's one way that cash can leave the business. A second way is by us paying off our vendors or suppliers from a credit purchase that was established in the purchases journal. Right? We're owing, and now comes time to pay it off and actually using that cash. And that's a second way that cash can leave the business. Okay? And then thirdly, how does cash leave the business? By having some other kind of expense. Paying insurance expense, utilities expense, okay? And now you know all of the different journals and what they are consisting of in terms of the entries. Okay, so now let's talk about each of them, what they all include, how they are structured, why they are structured the way they are, and how to use them. So first, the sales journal. Sales journal, recording only credit sales. Only credit sales, what does it look like? I'm going to have columns. And by the way, you might see sales journals, cash receipts journals, purchases journals, cash payments journals that look different depending on the type of book you're looking at. You might look it up on the internet. You'll get different headings in the columns. But as long as the main accounts are being shown, then you can make it up however you want, right? There's no direct, ingrained way that you have to set up these journals. Okay? You'll see different styles depending on the type of company or the individual themselves. So don't get caught up with that. For the purposes of tests, definitely tests, exams, all of these journals will be provided for you. All right, so you don't think that you have to memorize what they look like or how they're structured. They will be provided for you, and then you just have to fill them in. Okay, but for the purposes of this video, I'll actually draw it out and emphasize the important accounts that need to be listed in each of the headings. Firstly, the date, okay, followed by account debited. Well, actually, in the interest of space, we'll put our DR abbreviation. Okay, account DR. Then invoice number. Then PR. Okay, and then accounts receivable DR. Sales CR. Okay, and then cost of goods sold DR. Inventory CR. Okay. So each of them. Date, we know what that is. Accounts, account to debit. This is the point where we talk about subsidiary accounts. Subsidiary versus controlling accounts. The two controlling accounts that we are dealing with in the special journals conversation is accounts receivable and accounts payable. Those are the two controlling accounts. And related to the sales and cash receipts journals, we have the accounts receivable controlling account. Because if you're making a sale on credit, your accounts receivable is increasing, and it's related to the sales. Accounts payable will be part of our purchases discussion and the purchases journals. purchase journals and cash payments journal. So for now, let's talk about that first controlling account, accounts receivable, and the subsidiary accounts associated with it. The subsidiary accounts that go with it are each customer's accounts receivable. If we're making sales, who are we making the sales to? Our customers. And each customer will have their name dash accounts receivable. Or you can have it the other way around, accounts receivable dash their name. Okay? So that we know exactly how much each customer is owing and how much each customer has paid off along the way. So a separate accounts receivable ledger for each of those customers, and therefore the subsidiary ledgers are, when combined, the total of the controlling account ledger. Our customers, Andrea, Louise, Tabitha, James. Okay? Those 4 customers. Each of them, Andrea, Louise, Tabitha, James, will have an accounts receivable next to their name. And each of them will have their separate T accounts or separate ledgers. And then the accounts receivable main account will be isolated from those 4 in its own ledger. And each time a transaction occurs, we will update the customer's subsidiary ledger right away. For example, March 1st. March 1st, we are making a sale on account. We sold something to a customer on credit. And in this second column, we are going to specify which of those customers it is. Sounds like it was Tabitha. So, accounts receivable connected to Tabitha. Okay, accounts receivable dash Tabitha, and her last name. This is the account to debit in the transaction. And essentially in any of these journals, any of these 4 special journals, we are doing the entry, debiting something and crediting something, just like we did in the general journal, except it's going to be in this table format. And therefore, all the information will be listed in the appropriate columns. Invoice number will be simply that sales invoice that is part of that transaction. And you know what a sales invoice looks like. I'm sure you've all received one. It's just a more elaborated, more detailed receipt. There's examples of them in the textbook. There's examples of them in the PowerPoint slides. And they will have all the pertinent information dealing with that transaction, what you bought, the name of the customer, the shipping terms that we talked about. Shipping terms, FOB destination, FOB shipping point. I have a note on that in the last video, or in the periodic perpetual video. What is going to be used to deliver it, a truck, a plane, a vehicle, a skateboard, a bicycle. And maybe a salesperson that we want to credit for that sale will be specified there, particularly if we're paying them commission. And then, of course, at the top right will be the invoice number. The top right of that, usually in red, let's say the invoice number here is 101. So we're just going to make sure it's referenced here in the special journal. Okay? PR now, post-reference, means that as soon as we make this sale to Tabitha on March 1st, we are going to her accounts receivable ledger, not the accounts receivable controlling ledger, not the mother of the baby subsidiaries, but only Tabitha's accounts receivable subsidiary ledger. We are going to update right now on March 1st. And we are leaving the accounts receivable controlling the ledger alone for now. Just go update hers by debiting it for, what's the amount of the sale? $400, let's say. $400 for the sale. Notice that this column here debits accounts receivable and credits sales at the same time. So therefore, you only have to write the number once. If you prefer, you can put accounts receivable debit in its own column and sales in its own column as a credit, but then you have to write the number twice. Not that it takes that much more time, but maybe that's less confusing for you. So again, it goes with preference and particular styles on how you set up these journals. But in effect, you are debiting accounts receivable, crediting sales at the same time. All you have to do is write in the 400 here. Okay? And then to our periodic perpetual discussion, in the perpetual system, when you make a sale entry, you have to do a double entry to record how much you paid for it, the cost of goods sold and the inventory that is now decreasing as a result of that sale. If you're using the periodic system, then you don't need this final column because the periodic system does not record inventory continuously. But we're doing the perpetual system because we want a more accurate update on inventory after each sale, after each purchase. In this case, after the sale, whatever we paid for this 400, we will also record here, let's say 150, as a debit to cost of goods sold and a credit to inventory, because cost of goods sold is in essence an expense, and we have to record our cost of this $400 revenue, sales revenue, right? And then the inventory is being credited here because, think about it practically, you had the inventory, but you sold it. So what has happened to inventory? Has it increased or decreased? If you sold it, the inventory has decreased. Less is in your warehouse or in your closet. Right? That's why it has to be credited. And then similarly with this column, you can split these two into their separate columns. Cost of goods sold, debit, inventory, credit, if it's better for you. And then back to this post-reference column, as soon as we updated Tabitha's accounts receivable subsidiary ledger with a 400 on the left side, because we're debiting it, we will check off, come back to this journal and check off the post-reference column. Only when we've updated her ledger. Okay? Now let's say on March 5th, we sell to Renee. We just met Renee on the street. She's a new customer, and she bought something from us. On March 5th, accounts receivable, Renee gets specified here, her subsidiary ledger. How much did we sell to her? 300. What's our cost of that 300? Let's say 100. As soon as we update her subsidiary ledger, okay, which is step 2, basically you're going to the ledgers. Journalizing step 1, ledgers step 2 in the accounting cycle. You updated her ledger, now you can post reference. What's the invoice number? 102, let's say. And that's how it goes. Remember, the accounts receivable controlling account has not been altered yet. We wait until the end of this month, March 31st, to get a total here. For now it's 700, if we just say that we had these 2 sales in March. 700 is the total of that month that we sold on credit. So this full 700 will now go and be posted in that accounts receivable controlling account. Only at the end of the month. So then you're dating it March 31st on the left side of the accounts receivable controlling account, 700 there. Okay? So if we wanted a detail to find out how did we get that 700, then we can go to all of our customers' subsidiary ledgers. Okay? And there's that. Sales journal only recording the credit sale. When they make a payment on it, we will put it in the cash receipts journal, not in the sales journal. Okay? This is the extent to what you have to do in the sales journal. Just record that credit sale. Okay? Clear on that? Clear on when to record in the subsidiaries and when to record in the controlling account? Good. If not, rewind. If so, let's continue to the cash receipts journal. So cash receipts goes with the cash or with the sales journal because now you're collecting or you're potentially collecting on some of those accounts receivables. Okay. Cash receipts, again, all cash inflows into the business. All cash inflows, what does it look like? Date. Okay, date. Now cash. Think about the cash receipts journal. I'll put cash debit here. Cash receipts journal, what did we just say and what did we say earlier in the video? All cash inflows, meaning anytime you receive cash, for whatever reason, it gets recorded in this journal. And therefore, cash will always increase in this journal. That's why it's the first column, and that's why it's debited. Okay? Next column, sales, discounts. So sales disc, also debited. Why debited? Because it's a contra revenue account. Sales is a credit. Sales discounts decreases sales, so it is a debit. All right. Now accounts receivable. Account receivable being the credit. Account receivable is one of the ways that we can collect cash. Remember, the account receivable was set up where? In the sales journal. And now it's being paid off, possibly. That's one of the reasons that we can be collecting cash here. Another reason that we're collecting it is directly making the sale here, sales, credit, because we're making a credit sale here. So receiving cash right away, not having to wait for an accounts receivable. Okay? Now, follow that with let me see here. Cost of goods sold and inventory. Okay, cost of goods sold and inventory. Credit, debit. Stay with me? Yeah. Okay, cost of goods sold. So we'll show how these get impacted. And then, if you can't see it, then hear it. This will be called a sundry account column, followed by a PR, followed by a sundry amount. Okay? Sundry amount. And so what do we got? 9 columns, right? 9 columns make up the cash receipts journal. And that's because we have those 3 ways that we're receiving cash, and each of those 3 will apply to different columns. You're not going to be filling out every column for each of the transactions. Let's say on March 1st here. March 1st, we collect. No, let's start off with an investment into the company. You invest into the company $200,000. we know that any inflow of cash for any reason will always debit cash, so this column will always be filled in for this journal. 200,000, okay, from an investment. If it's an investment, sales discounts doesn't apply. Sales discount will only apply when an accounts receivable is being paid off. Okay? When a customer is paying off their accounts receivable, that's when a sales discount will apply. So we're not also making a cash sale in this case because it's an investment. So this we can leave blank. Cost of goods sold inventory, no, nothing is being sold. Leave this blank. Sundry account though. Sundry account, sundry means specifying the reason why we are receiving the cash. Okay, so this is where, since capital doesn't have its own column, we will say here, capital is the sundry account, right? Sundry, because it doesn't have its own column. Specify it here. PR, in the PR column, you will check off only if you're updating one of our customers' subsidiary accounts. Then you will check it off. That's the only reason you will check off the post-reference column. But if you're not updating a subsidiary ledger, then here is where you can put the actual account number. So capital's account number. What is capital? It's an equity. Equities are what number in the chart of accounts? 300s. So let's say 301. You see? It doesn't get checked off, but we can provide more detail inside the journal by just giving the account number. And then the sundry amount, to balance this entry, $200 debit to cash, $200,000 debit to cash is a $200,000 credit, okay, sundry account credit to capital, because we've specified which account. You see, so the entry has been done now in the journal. And that's all you have to do for the March 1st entry, when an investment happens. Now let's get to that second reason that you can receive cash. Somebody pays you off. Who owes us from the sales journal? Tabitha and Renee. Okay? So Renee paid second, but yet she's here paying us first. So Renee is going to be the one that we specify in the sundry account column. Well, actually, she only purchased it from us on March 5th. So let's say it's March 8th now. March 8th, she's paying off that $300 that she owes. So we are receiving cash. Cash gets debited for the $300. Oh, and now sales discounts. If she's within that discount period, remember discount period is offered either by us to our customers or by our vendors to us. And we explain what that means in the periodic perpetual video. Very quickly, let's say it's 2/10, N/30. Means you are entitled to 2% off if you pay within 10 days of that purchase. And net 30 means that you have 30 days credit period to still be in good standing as long as you make the payment within 30 days, but you are not given a credit or a discount if you pay from day 11 to day 30. You're just kept in good credit standing with that customer or vendor. In this case, she bought originally whatever she bought from us. Okay. She purchased it from us on March 5th, and now on March 8th, she's paying us off. So that's within the discount period, and let's give her 2% off of that 300. 2% off of the 300 is what? $6, right? So sales discount will be 6, and that means we're going to have to actually change the cash amount to $294. Because if we gave a discount, that means we're actually and factually receiving 294 cash. Sales discount has to be debited for 6. So we have on the debit side 300. You see, they're both debits. That means we're going to have to credit something for the full 300. And what is happening here? She's paying off her accounts receivable. So accounts receivable will be credited for the full 300. Accounts receivable, notice that it just says accounts receivable in general. So we need to now specify, well, whose accounts receivable subsidiary ledger needs to be credited for the 300. That's what you put now in the sundry account column. Accounts receivable, Renee. See? So the sundry account helps us to specify exactly which account needs to be credited in this journal. Right? And sales and cost of goods sold inventory columns can be left blank here as well, because we're not making that cash sale here. We're simply receiving the cash because the customer is paying off what they owe us. But we're not selling it at this point, you see? So now go to Renee's subsidiary ledger and update it by crediting on the right side her account for $300. So in effect now she owes us nothing. Once we do update it, then we come back to this journal and check off the post-reference column. You see? And that's all in an effort to keep things audited, keep things cross-referenced and confirmed and connected to each step so that we're more accurate and able to go forward with the steps in the whole cycle. And sundry account now gets blank, is left blank because we've already done the entry. $294 debit cash, $6 debit sales discounts, $300 credit accounts receivable. All right. And by the way, you're not going to that main controlling account right now. You're going to wait until March 31st to update all of the general ledger accounts. The only accounts that you're updating along the way are the subsidiary ledgers, the specific customers. Those are the only ones that you're going right on the same day that it happens. Everything else gets updated at the end of the month. Okay? So that means cash, sales discounts, accounts receivable controlling ledger, sales main account, cost of goods sold, inventories, each of those ledgers, all of them at the end of the month. Only the subsidiary ledgers get updated right away. Okay? Now, our third way to receive cash in the business is by making that direct point of sale cash sale. Let's say on the 9th. We make a cash sale. Cash will always increase in the cash receipts journal. Cash sale for 500. Let's say 5,500. 5,500 sales discount cannot apply on a cash sale because it can only apply from a credit sale previously made. So blank. Accounts receivable, we're not collecting an accounts receivable. We can leave that blank. Sales. Yes, this is where the sales column gets used because we're making that sale with cash right now for 5,500. Right? So the sales credit revenue increasing by 5,500, just like cash does. And cost of goods sold inventory now will also need to be updated because remember that double entry. This is particularly in a perpetual system. In the periodic, you don't even have this column. This is a perpetual system where we have to always update inventory. So what is our cost of this $5,500 sale? $3,000. Okay? $3,000 simultaneously debits cost of goods sold and credits inventory. In the sundry account, you can just say cash sale. Okay? So you can think of a sundry account to specify things. Specify what has happened. If you're just putting the subsidiary account of the customer, then that tells the whole story. We know that the account receivable is always credited here in the cash receipts journal. And by putting the customer's name, you know exactly what happened. But here, you're just providing detail to give you a better idea on why you received this cash. Okay, that's what sundry account column is, kind of a versatile column heading in that sense, because it's just asking for more detail. Okay, cash sale, and here you could say dash, okay? If you want to specify the account number of cash, 101, 106, whatever it is, that's fine. Whatever detail you want to put in the post reference, but dash is fine. You know that it's a cash sale. And sundry amount, not necessary because there is no sundry account, such as with capital. The two accounts have already been journalized, cash and sales. In this first entry on March 1st, the reason why sundry amount needs to be credited is because nothing else was credited prior to that. You see? Specifically with the investment. And just think, investment is the only thing that needs to be put in that sundry account to make it that much easier for you. Okay? So, there is the cash receipts journal. And now related to sales also, a couple more points. A couple more points related to sales is that sales return and allowance, the other contra revenue account, right? So let's talk about that. Remember at the beginning when we said what goes into the general journal, we said all adjustments and all sales and purchase returns and allowances. And since we're talking about sales and cash receipts, we're talking about sales returns and allowance. Sales returns and allowance will be communicated to the customer through a credit memo. And why is it called a credit memo? Because you're crediting accounts receivable. You're crediting that customer's account. And therefore, you're just providing them all the details in that credit memo of their return. Let's suppose they returned some of their merchandise. Okay, we already mentioned why they would do that in the periodic and perpetual video. Something they don't like about what we sold them. They're returning some of it. And remember, the return part of returns and allowances is returning it. The allowance part is they're keeping it, they just want a reduction in the price. So let's say one of those they're doing, and therefore we have to give them a return and allowance. We have to give them a reduction in price or credit the account because they're returning. So they're returning, let's say, $200 worth. You notice that in that cash receipts journal, we do not have a column for sales returns and allowances. That means it has to be recorded in the general journal. And then it will be recorded in the general journal just like we demonstrated in the periodic perpetual journalizing. With debiting sales returns and allowances, crediting inventory. No, excuse me, crediting accounts receivable. Crediting accounts receivable because the customer no longer needs to pay us that $200 worth, and therefore accounts receivable is decreasing by crediting it. Okay? So a regular entry, that's how it works. The sales returns and allowance is a contra revenue. That's why it gets debited for the 200. And then you're just, again, sending the customer that credit memo again because the accounts receivable is being credited, detailing what they returned and their information, There's examples of that in the textbook as well as the PowerPoint slides as well. Okay? And then in the explanation for that general journal entry, you'll just put credit memo number 101. Okay? Those will have numbers as well, just like invoices have numbers, just like everything has numbers in accounting. Okay, so that's sales returns and allowances, and then the other point is a schedule of accounts receivable now. After you have concluded the journal entries, now you're just specifying how much each customer still owes at a certain point. And that's why keeping track of each customer's subsidiary ledger is so helpful, because now you know exactly how much they paid off in relation to what they owed and how much they still owe. And that's why we're just updating. For example, we would say schedule of accounts receivable says accounts receivable Tabitha on, let's say, April 30th. Accounts receivable Tabitha, remember she did not pay us off yet. We sold to her, I think it was 500 in the sales journal on credit. So her accounts receivable still has 500 owing as of April 30th. That's when we're inquiring about it. We could be inquiring about it on any day. Okay, I just made this day up. Whatever day you're wondering how much is still owing in your accounts receivable, that's when you can prepare this schedule of accounts receivable. Tabitha owes us 500. Then let's go to Renee. Since we have not had an update on what Renee owes yet, we will put that she owes us 0 at this point. Okay? Then if we request it again, let's say on May 3rd, we won't put Renee 0 again. You only put Renee 0 the first time to update it, because the last time you probably inquired, she did probably have a balance in between when she first made that credit purchase and when she paid it off. Okay? So there you go. Schedule accounts receivable, that's it. And now just give a total. So we could say our total accounts receivable that we're expecting still is 500. And how is that 500 distributed between all of our customers? Okay? Simple as that. Accounts receivable is or a schedule of accounts receivable. And then when we talk about schedule of accounts payable, those are the easiest things to do in these chapters. Okay? Okay, so what point are we at? 48 minutes. Yeah, thanks. 48 minutes and 7 seconds is when we are ending the sales conversation and beginning the purchases conversation, and therefore talking about the purchase journal and the cash payments journal. So purchases journal. So conversely to the sales journal, the purchases will record all credit purchases. Any purchase we make on account with our credit cards or on credit will be put into this purchases journal. Credit purchases. Okay, what does it look like? Date, then account credited. Which account will be credited this time? And realize that why is it an account credit is because we're dealing with accounts payable this time. If it's all credit purchases, now we're talking about accounts payable, and therefore we get to that second controlling account where accounts payable will have a bunch of subsidiary ledgers for each of our vendors or suppliers. Okay? And similarly, each time a transaction happens to one of those subsidiary accounts, you update it on that exact day. And at the end of the month, you will go to the controlling accounts payable and give the total amount posted into that accounts payable controlling account ledger. Okay. Invoice number, PR, okay. Then you're talking about accounts payable. Okay, credit. Inventory. Debit. And amount, or excuse me, account. This last one will be called account because you're purchasing something other than inventory. Debit. Okay? So the first four are exactly like the sales journal, except this account is a credit because it's accounts payable. In the sales journal, it was a debit because it's accounts receivable. So all credit purchases. Now we're purchasing from our vendors. March 1st, we are purchasing from Sam, George, Stacy, those three. On March 1st, we purchased from Sam. Therefore, accounts payable, again, we're purchasing on credit. Accounts payable, Sam. Invoice number, purchase invoice number, 101. We'll go back to the post reference as soon as we update Sam's accounts payable subsidiary ledger with whatever we purchased from him, which is, let's say, $250. Okay. $250. Inventory, $250. And go to Sam's ledger, credit on the right side for $250. As soon as you've done it, come back to this purchases journal, check off post reference. Okay, so what is happening here? You know that all purchases in the purchase journal are credit purchases, meaning accounts payable is increasing and therefore credited. If you're purchasing inventory on credit, you fill in this column, inventory debit. And remember, inventory is specifically designated for the purpose of selling, not to use in the operation of our business. Purpose of selling, that's why you debit it here. If you are purchasing another asset besides inventory, and therefore using that asset in your business, let's say equipment, machinery, supplies, ovens, whatever other asset you're talking about, that's what you will specify here. That's why it says account to debit. Okay? Account to debit. If it's not an inventory item. In other words, you're either purchasing inventory on credit or you're purchasing another asset on credit. And that will determine which of these final two columns you are filling in. Right? And remember, purchases is dealing with inventory in terms of, let's say we just had one word. If you say purchased this amount of goods, it doesn't have to say the word inventory in there for you to know that it is talking about inventory. Purchased goods is purchased inventory goods. Okay? And then that means that you have intentions to still sell it. On March 1st, we purchased from Sam $250 worth of inventory. Accounts payable again because it's a credit purchase. March 2nd, Who's our other two customers? George and Stacy. March 2nd, we purchased from George. Accounts payable, specify George. Invoice number 102, remember these are the purchase invoices now, very similar to the sales invoices. You can see examples of them in the textbook, in the PowerPoints, but I'm sure you've seen them in your practical dealings as well. Accounts receivable from George, let's say 200. Okay, and now let's say we're not buying inventory from him, but instead we're buying supplies. So here is where you will specify supplies. Okay? And that's it. And then you get the idea, right? We don't even have to buy anything from Stacy for this example. Go to George's accounts payable, ledger, credit right side for 200. As soon as you've done it, come back to this purchases journal and check off the post reference column. And now you have cross-referencing, cross-auditing, further verification that everything is flowing smoothly through your postings and journalizing. Now let's say it is March 31st, end of the month. Get a total for how much is in accounts payable. In this case, $450. This $450 gets posted into that accounts payable controlling account on March 31st for $450. So as far as March goes, accounts payable only has the one number, even if we've made 1,000 sales in this month. Only the one total number at the end of the month will get put into that accounts payable. Okay? Inventory, same thing. At the end of the month, put this full 250 in there. Supplies account for the 200, put it in there. There's the purchases journal. Okay. And now the cash payments journal. Remember, the cash receipts journal is all inflows of cash. All inflows, and we mentioned the three main inflows are an investment into the company, making a direct cash sale, or collecting on accounts receivable. So now in the cash payments journal, or cash disbursements journal, cash disbursements, cash payments, same thing. We'll start with the date. Date is how you start all of them. Remember how important dates are, especially when you're talking about purchase discounts, sales discounts. Dates are for sure important. Now we're going to follow this journal with, though, in the second column, with a check number heading. Check number. And why check number? Because anytime you are paying something with cash, anytime you're making a payment of cash from the business, it has to be recorded using a check. Okay? Why? Because just like everything else, we have to track it. We have to have a track record of all of our checks. And just like our invoices and purchase orders and purchase invoices, sales invoices, debit memos, credit memos, all of them have numbers at the top right. Check numbers will have numbers. Okay? Depending on the style of check, in terms of where it is located on that check, but that might differ. But either way, we'll have a check number somewhere on that check, and that way we can know where the cash went, because we will look to where all the checks are located. Check number, then cash. Cash disbursements means cash is always going to be decreasing, so it has to be a cash credit. And by the way, this is all outflows of cash.